we've got and I really need help. Now, a lot of the audience here would be replicating the business portfolio, which I know that you guys are all value managers. We've moved towards you in a big way, but I'd like to know your thoughts on two exponential stocks that are growing at over 50% or and have continued to do that, Uber and Cloudflare. Or is it just so far away from your comfort zones that you just don't want to talk about them? Si?
I'm happy to talk about Uber. Very interesting business model. Doesn't yet make money, but I think it doesn't make money because of its competitors. So Bolt, for example, and others that raised enormous amounts of private equity money and continued to raise money on the back of growth in revenue without profitability, which was kind of the model during COVID. And now that we've got rates up at 5%, I think a lot of the competition is starting to fall away, and the economies of scale will come, and the pricing will normalize and probably move up from a revenue point of view. And I think it will emerge as a leader in its field. And it already has gone up, I think, some 50% from its bottom in the last couple of years after a very dull listing. But I actually, it's one of the few businesses that I can see making a pathway to decent profitability and cash flow in the future. No guarantee of that, but I think it's looking better than it has done. The valuation is still ridiculous relative to current profitability, but it may grow into itself. Cloudflare, I'm not an expert on. It looks a bit hyped and, hard to know if that ever makes money.
So I don't know Cloudflare. That fish doesn't swim into my pond yet. But Uber is interesting in that you would think they would make money. You think, well, you don't provide the taxis, you're just providing an internet service. Everybody else is paying their own, paying for their own taxis and paying their own insurance and just providing the network. And so you think it's capital light. This thing should be generating high returns, but it doesn't. And part of that, I think, is Uber Eats. And I think food delivery is a terrible business because it might be capital light, but it's discount heavy. On Friday night when Uber Eats is offering a discount or Deliveroo is offering a discount, I don't really care where I get my stuff from. I'm going to go to whoever's giving me a voucher. And then obviously they've invested in driverless cars and if they maybe cut back on that. But Lyft came out with results recently and they were terrible. And Lyft doesn't do the food delivery as far as I'm aware. So I think it's been really challenging and, but it is interesting in that conceptually you think, well, it's capital light because they don't provide the hotels. I mean, Booking.com, no hotels. Uber, no taxis. Expedia, no airplanes or whatever. These businesses should be capital light and therefore be making money, but it also means that their barriers to entry are low. And so while they're not nothing, I mean, you and I could start a food delivery business tomorrow and restaurants would sign up if we only took 10% of their money, not 20. We couldn't start a taxi business tomorrow. We probably could, but just with a few taxis, wouldn't have a global reach. So, so I think, yeah. But they're not making money, and so therefore I'm not really interested.
No comment.
Yeah, I think I'd like to make two comments, probably not as much directed to the valuation of these companies, which I don't know. But I think the one comment is, I think stocks like Uber illustrate the difference between value investors and growth investors, where growth investors invest into some sort of story which might or might not, as Sai points out, work out. If it does work out, you make money. If it doesn't, you don't make money. Whereas value investors would rather look at a balance sheet, an income statement, and see what's happening at the moment, what you're paying for what this is, and reasonable prospects, and make a decision based on that. So it's playing the cards that are dealt in front of you rather than buying into a story. So Uber is a classic example of the difference between a growth investor and a value investor. So we don't own Uber and definitely don't own Cloudflare because that is very, very expensive. And the second comment I'd like to make is that stocks like Uber and Cloudflare also speak to the long-term capital cycle in markets where, because of cheap and even free capital in the US and other places of the world, a lot of money has been attracted into venture capital funds, private equity funds, growth investors, like crazy people like Kathy, what's her name? Kathy Wood. These people have been flooded with free and cheap money. So a lot of capital has come into asset-light business model markets where there's huge competition. And there will be winners, but it's very hard to pick the winners. And the competition to be a winner in those markets is intense. So I think that drives down the profitability of all players in those markets, which is why these guys don't make money, because the competition is just so intense because of all the capital in the market. So as a value investor, I'd rather take a step back and say, where is the capital not going? Where is there little competition for my capital? Because then I can earn high returns on that capital.
There's a really good book there to add, Engines That Move Markets. It is very big on the point that you just made now about, sure, Uber, Cloudflare, I can give you 100 reasons why the network effect is going to work for them. I'm sure Stafford and I would be on the same camp there. However, to pick the winners is very difficult. The other reason for this is that very well documented in there, the rise of charismatic business leadership, which is a growth investor's lifeline and love. It's written by Professor Ted Lowe, beautifully written, and it actually explains how in years gone by, there was no such thing as a charismatic business manager. They were there to make money for the shareholders. Now it's a story. You've got to have your PR team. You've got to look good. You've got to be able to sell the message, sell the idea, the dream, which may or may not be a dream, which may or may not have substance. And it's a real good book. And I know there's quite a few copies which I asked them to bring. So, to your point,
the classic story is Sequoia Capital, which is a blue blood, highly regarded venture capital firm investing into FTX on the basis of no due diligence. And this is a very highly regarded VC firm based on Sam Bankman-Fried's story. And these guys invested $200-300 million into that story. And that's a sign of what's going on in markets, a small sign of what's going on in markets, and the sort of places you want to avoid. When you see that sort of thing happening, that's where you want to avoid investing, because there's just so much capital being thrown at these people that the returns on that capital, is going to be poor.
What about the comments that Stafford Marcy did have about the stocks that are exposed to AI, which is the next big thing? He showed us in 5 days, ChatGPT, as he said, had 1 million, fastest in history, 1 million users. That is something new. Do you think the same principle applies, that it's very hard to find the winners in AI or the next explosive growth opportunity?
I think monetizing it is a separate question. I mean, you've got to show me a path to monetizing it. At the moment, all of us can go on Chat GPT for free. If the server's busy, yes, you can sign up and have a subscription which gives you a right to be on the server. But everyone's going to be chasing the same thing as well. Microsoft and Bing and all of them are creating their own, Google looking to do something as well. So it's difficult to know who's the winner and how to monetize it. It's almost like free. So yes, it's got many implications and it can be used in many different solutions, and it can help you work out how to, efficiently amend a business or a business plan, or, work out holes in various businesses. But it's hard to know exactly. It's a great idea. How do you monetize it?
I agree. I completely agree with Sai. And I think the other...
That's why we can have a debate there.
I'm the only debater.
I'm not a value manager like the two of them at all. But this is, I can't disagree, this is a value cycle right now. I mean, you've hit these top interest rates in the US. So I would have loved to argue with him a few years ago, like in 2020 and 2021, but it would have been different. But I think the cycle obvious now.
And I think the problem with technology is that, they talk about not the leading edge, the bleeding edge. That's the problem. You're going to lose a lot of money because imagine, I mean, if Facebook came out tomorrow and said, right, everybody's got to pay $5 a month to use WhatsApp, you bet your bottom dollar we all move into Telegram. So the benchmark is naught, it's free. And so if ChatGPT right now, we're all looking at ChatGPT, but if ChatGPT wants to charge us, which they're charging some, they've got a premium rate, well, we might go back to Google. But all of a sudden it's put Bing on the map. People go, oh, actually, no, I like Bing and I don't need the ChatGPT, I'll just use Bing. And so Microsoft are going for Google. They've said it publicly. And so I think it's going to lessen the pool.
And if fangs are applying their teeth to each other at the moment. Okay, so let's get into your sweet spot. How long might this value run last? Sai has now said, you guys are in the pound seat. The growth chaps they're going to where you were a few years ago. How long, Pet, do you think the value run, how much runway is in it?
I think these cycles don't repeat, but they rhyme. So I think the down cycle of value or the up cycle growth has been much longer than previous cycles. And therefore, I think the value up cycle could be much longer than previous cycles as well, because there are so few value investors left in the world today. There are almost none. So, a really interesting thing, when trends change, it's hard to pick them up. But they're only confirmed not when asset managers individually change their asset allocation, but when investors change their asset managers. And we're still a way away from that happening. I mean, you said it earlier, the money isn't flowing in rapidly into 361. They're getting money, we're getting money, but there isn't a big change from 91 or Coronation or Allen Gray or, to Randmore or Merchant West or 361. There's a flow, but it's not rapid. Investors have not yet changed their asset managers. And once that starts happening, then that trend will probably start accelerating. And at some point, value like in 2007-8 will become expensive.
But you haven't answered my question. What kind of runway?
I think it's long.
More than 3, more than 5?
I'm self-interested here, so you've got to take it from where it comes. But I think looking at the setup, it looks like the runway for value could be quite long, given that there are no value investors left in the world. Most stocks are large cap quality growth stocks. Value stocks are small. They're uninvestable for the big fund managers. So that the fund management, the shape of the fund management industry has to change before you can even start thinking about looking for the end of the cycle.
Sure.
Oh, I agree. I think it's going to be long. And I think, people have not started shifting. Imagine you're a client of an advisor and you got your performance last year, and then I think you probably find that many of them said, don't worry, these are good managers, it'll come back. And then the first 2 months, like, phew, thank goodness for that. We've seen the rally, and so they breathed a sigh of relief. But now it's going to start rolling, inflation staying high, interest rates are carrying up. Interest rates have not fallen, and now you're seeing the growth. So for the next couple of quarters, we're going to see these big tech companies reporting disappointing earnings. And I think then it's going to dawn, and then you're going to see selling from those holders. So the cycle's only just beginning. And it's going to be a lot. The elephant is so big. You got $7 trillion or whatever, and 10 companies, something like that. They would call me maybe a 6 trillion. And there's going to be a shift, and you don't need much of that to shift. Europe beat North America last year, even though there was a war. That's quite astounding, and is well ahead this year.
So you look at both. Does this mean that you just not going to look at growth companies in the?
No. So we look at both. We look at more quality companies on both spectrum, and I think there'll still be growth companies that will do well. I don't think it'll be as easy as one cycle that value now outperforms growth for 10 years, because I think if you get a meltdown in the economy, you get the Fed to suddenly change tack maybe in 6 months or a year's time, suddenly cuts interest rates. The next thing you know, we're off to a growth market. Everyone's saying, well, we're going back to the zero interest rate environment. We've got deflation, and you've now got to buy long duration assets again, which may spark inflation again and then raise rates. I think we're going to go through a very volatile time, but I would hazard a guess that value from this point would still outperform growth. The growth multiples are ridiculous, and not only are they ridiculous, they're ridiculous on normalized earning numbers. There's this whole story about GAAP versus non-GAAP earnings in the US,
Which means
which means GAAP are like the real numbers that the accounting standards you must show. And then companies put their non-GAAP earnings, their normalized earnings, to take out certain one-offs or strange things that have happened to them. And I think there's a massive abuse of that system. And there's another thing that's come into the system has been this whole SBC, share-based compensation payments, where companies have been incentivizing their staff, etc., not on the salary line so much, but by giving them shares, stock. And it's worked very well in the up market, and they've taken that number out of earnings. But actually, these are actually normal costs because they actually are salaries and bonuses, but being given in shares. And you need to add all that back. So I think the market is even way more overpriced than people think on a proper accounting-based profit.
so it's almost like we're returning to basics. We're returning to the principles. Pitt, by the way, is the man who got all, well, not all, but many South Africans who attend Omaha, attend the Warren Buffett Berkshire Hathaway AGM. It's his fault. I think they should have given you some kind of a commission on hotels in Omaha. But is it like that? Is that the way you see it? Charlie Munger's views, Warren Buffett's views, the real old Benjamin Graham value investing approach that has stood the test of time for a long time, excepting recently, will come back into vogue.
I think you have to look at what it is, and what it is just pure common sense, rationality and pure common sense, and that might go out of fashion from time to time, but it doesn't stop working. So if you stick to common sense and rationality, over time, you'll do fine. There will be periods when you look pretty stupid, as we've gone through for a few years, but if you just continue doing what you're doing, you'll be fine at the end of the day. I mean, Sean showed the numbers. 2 years ago, people complaining and saying, hang on, what's going on? 6 years ago, people were complaining about my funds, what's going on, you stupid. But you come through at the end of the day and you're right, because you applied common sense, and that doesn't go away.
And Alec, one other thing, I agree with Pete. And one other thing is that they're not mutually exclusive. I mean, San Media I put up there, that's a growing company. So you just don't have to pay a crazy. We all want growing. I mean, you go and look at you'll find that share prices follow forecast earnings. And so why has Apple gone up? Because earnings have gone up. So we all want growing earnings. Great companies grow earnings. You just can't pay too much for them. And what you don't want to do is pay too much and then earnings start falling. And so they shouldn't be mutually exclusive.
We've got our competition, our fund competition, the fantasy fund manager, which it's already agreed he's going to come in. I'm sure the two of you are also going to join in the fun.
Is it international companies or just South?
Only South African, sorry.
Can we go short?
You got as good a chance as anyone. Doesn't matter.
You've got
6 months.
I'm not sure, but maybe we should work that in. Can you go short? What should those who are participating in this competition look for? It's a 6-month competition, so let's just remember this is not
swing for the fences.
The what?
You got to swing for the fences.
Swing for the fence.
No, you're going to swing 6 or a nix. I mean, that's it.
In 6 months. So this is like a 2020 game that's been compressed to 5 overs.
And these are fun. I mean, and I think why I like these games so much is you learn that investing is not easy. It's simple, but not easy. So I think it's a fantastic learning tool, educational tool. And I encourage everyone to take part because, if you don't take part, you just in the sidelines say, well, I can do better than that. I'll pick my own stocks. As soon as you put those names down on a piece of paper, the stocks you pick, and you're being measured every day, every week, every month, you'll see that it's not as simple as you think it is. So, and for me, that's a big takeaway. And that's why it's fun playing these things.
So swing for the fences, higher risk companies.
Yeah, and you pick 6, so you pick different risks. I mean, you don't pick all 6 the same risk. You pick them, and that's also you learn about portfolio management that way. I mean, when you're running a portfolio, people are talking about binomial risk. I'm sure that meant binary risks. When you're running a portfolio, you're taking risk. There is no such thing as a riskless investment. You are taking risks because you don't know what the future holds. You have no idea. Therefore, you own a stock which reacts in this way if this outcome happens, and a stock which reacts in this way if that outcome happens, and that's a portfolio of stocks. And that's a bundle of hopefully lowly correlated risks that you put together, and that gives you hopefully a good outcome over time if you put it together sensibly. And that's why, when you play these sort of games, you can learn that thing.
So let's just presume we can't go short. So what would you be looking at for going long?
In the South African market.
Only South African market.
Yeah, so I probably would stick. He's got ABSA or a couple of banks in there. I probably would go for a bank or two. I'd probably even go for a commodity company or two, maybe a Glencore, etc. The problem is when you fix yourself on 6 months, things may change. So, I'm not buying a stock today and not changing my mind often, even 3 days after I buy it. That's the difficulty in making it. That's why I don't play any of these games on Twitter where he's brave enough to put his 4 suggestions out for a year. Funny enough, we played an international one with hedge fund managers where you just pick one long and one short for the year, which is great because you really got a counterbalance because, you can take 2, for example, in technology and you know that one is going to fail. The one's, a great one was Lyft, Uber. That's just, someone did that last year. Uber is long at 23, Lyft long at like 18, Lyft's halved and Uber's doubled. So you're making 250%. So I prefer that type of a 6-month game rather than predicting 6.
And I think if you're looking at a 6-month horizon, you're probably looking at something where there might be a takeout happening, a buyout happening.
Yeah.
You could think about that sort of thing.
Like a Grindrod you'd probably take on.
Where there's asset realizations that could happen, you could think about that sort of thing. Those sort of things you can think about, and you probably get it wrong in any case. It's just fun.
Sure.
Well, I need to look at the fine print. 6 months, 6 stocks. Unless they swim into my pool, I'm not going to spend the time. I've got quite a lot on the go, so I'll have a look and see. But
You play your drums,
no, I'm definitely not spending a lot.
not letting your cat climb over the keyboard and perhaps pick for you.
I mean, I'll probably think about some international themes I've got and pick a local one. But, a local stock that sort of fits with that theme. Not that I'm a thematic guy. But
I know that you had another thing in mind with the cat climbing over the keyboard, but there was some time ago, Jeremy Woods, who used to work at the Sunday Times many years ago, he ran a competition where he took the monkeys. He just threw darts into the board and he called it the monkey portfolio. And the monkey portfolio outperformed a lot of fund managers. How is that possible? And would it be possible today?
Absolutely possible today. I mean, you can see the majority of fund managers underperform the passive index. So it just shows you that, it's very possible to outperform.
Over a short period of time, I would probably bet that the monkey will outperform more in more cases than not, if you limit it to 6 months or 1 year. But if you start doing, over 2 or 3 or 4 or 5 years, then I think it's going to start separating.
So you're just giving us a strategy for this competition. Put the allocate numbers, go on to, spin the wheel, as we did for the golf.
Well, I think you should
And have a go. Enter a month.
I would bet that one would be, the odds of it being the top quartile of all the picks would be quite high.
Well, we're definitely going to do that. Guys, we are coming to the end of the program. Thank you for sharing with us, but I can't let you go without giving us just a little bit of advice. I come up to you, I say, you're not allowed to give advice. I come up to you, I say, I'm worried about South Africa. I'm worried about my country. I have a lot of my money invested here in rands. I've got a pension. It's sitting on the JSE. It's a troubling time for me. Can you just leave us with perhaps some way that, getting back to my hope, I can go to sleep tonight and actually sleep happily rather than being really troubled about what might happen tomorrow?
The easy answer, if you invested in the JSE and you invested according to the index, I guess that more than half your money is offshore via Richemont, Anglos, Glencore, what else? British American Tobacco, Naspers process. I think probably 60 to 70% of your money is offshore if you invest in the all-share index.
So you can live in a warm climate and keep your money in a cold climate by simply investing on the JSE.
It's true. I wouldn't speak to the valuations of many of those stocks, but the fact is you have offshore exposure.
So a little message of hope from you?
I don't think hope is a good investment strategy.
Okay, outside of investment strategy.
I think be sensible and spread your bets and build your bundle of twigs according to your own risk profile, according to what you're comfortable with. But be sensible about it. Don't ignore things because you're scared of it, because it's that fear that creates undervalued situations and potential future good returns.
Yeah, I would say first of all, I was going to say the same thing. South African market is not representative of the South African economy. And if you've got pension fund money and it's Reg 28 compliant, hopefully you've got up to 45% of that money even potentially sitting offshore, number one, and the 55% that's onshore can be in non-South African companies. So your effective holding, in our general equity fund, for example, our effective Rand hedge holding is 87%. So it's nothing to do with South Africa. So be cautious. You can still live here, be invested here, and not be in South Africa.
Yeah, I don't think it's a patriotic thing. I live in the UK, and the only UK exposure I have is that which is via our fund, because all my money is in our fund. And I don't think it's like, well, if I live in a place, these days the world is so mobile, you're able to move your money around with not too much difficulty, although I do agree with Magnus. I had a board meeting last week for the fund, and just the day before the grey listing, and it is going to create problems and it is going to increase headaches. But I think one shouldn't, you owe it to yourself to invest where the best opportunities are, and don't worry about, well, I live in the UK, therefore I must have all my assets in UK stocks. I live in South Africa, I must have all my money in South African stocks. If the investment opportunities are there, great. If not, and on a risk-adjusted basis, then invest, the best way, the best manner for your money. That's what I would say.
Sean, Sai, Piet, thank you for your rational insights. I'm sure that we're all going to be leaving here a lot smarter, but certainly quite a bit more balanced. You've given us some wonderful insights and a reminder on risk and rewards, and that there is an upside. The privatization by stealth of South Africa has huge potentially. Thank you very much for coming all this way again, and thanks to everybody here.